Hello, my friend. Here we are with David Jaffee again on how to roll a position, how to manage and roll a position, an option position that has moved against you, that the underlying has moved against you. You know, when you sell a put and the underlying goes up, the option that you sold expires worthless and you get to keep the entire premium. But if the underlying goes down, then you are in it for a loss, except that if you buy back that put option and sell another put that is longer dated, then you have more time for your position to expire worthless. Ideally, the cost of buying the put will be offset by the premium you receive from selling the additional the new put, because of the additional time value of money. So this happens, you know, of course, when you are very close to the strike price. If it moves aggressively against you, then it's a different story. Although if you stick to the same strike price, it's likely that the intrinsic value is going to be there for you. And on top of that, the time value would make the difference. So think about that. So you get more time so that your trade can be a winner, and so you don't lose the money in the original trade. So if the second trade expires worthless, then you turn the losing trade into a winning trade. So if the underlying continues to go down, you can roll it forward again, counting that eventually, with more and more time and the upward bias in stock prices, it is likely to make you money, statistically speaking. So that underscores the importance of picking underlines that will go up. David has advocated in the past, he has a short list of stocks in his watch list. One of them was Boeing, and we all know what happened, hindsight of course, to Boeing with the 737 MAX problems and then the pandemic on top of it. The price came down materially. And so to avoid the individual stock risk, I think that you could sell these puts on the index. Of course, the index has a lower premium than individual stocks because it has lower risk, but still you can make money on the index and not have that diversification risk. So if you get assigned and you have the capital, you could just sell covered calls on that until you get called away. That's the famous wheel strategy on options. But if not, you just buy the losing put position, buy it back, and then sell one with the same strike forward, say 6 months into the future or 12 months, and that will do the trick for you. So again, David says that you should not trade too large. That means that you shouldn't sell too many contracts, so that you have the capital and the flexibility to face a losing trade. If you do cash secure puts, then you don't have a problem. David trades larger than that for his own account. That's because he is comfortable with that risk, but not everybody is. So if you're a beginner investor, perhaps you could start out with cash secure puts and doing it only for like 5 or 10% of your overall portfolio, and you will do very well. Suppose you had, like, for example, a stock index portfolio of $100,000 or so. You could start selling puts on $10,000 worth of it, and over the last 40 years, the S&P 500 has had 21 years in which the index came down 10% or more from the recent high. This is a correction. So if you're selling puts 10% below the strike, you may be called on these, or maybe not. I personally prefer to sell puts on the index for 6 to 12 months into the future. So in 21 of those years, you might get assigned, and of those 40 years, only 8 years ended down, and the rest of the time it recovered, even though 21 of those years, they had an intra-year drop. So if 8 years ended down, then 32 years ended up, and this goes to show you the upward bias. And on top of the 8 years that it ended down, the average yearly return on the S&P 500 index, if you include the dividends reinvested, was 10% return per year. And that's not bad at all. So again, just to recap, if you're selling puts, you want the underlying to go up. If it goes up, the put will expire worthless. If it just goes sideways, it will expire worthless if you sell a strike price below, right? And if it goes down up to your strike, then it will expire worthless. If it goes down below your strike, but still within the premium that you receive, you would break even. You wouldn't lose any money. It's only when it goes down materially. And if you're doing it on the index, I would say it's a good bet that you could roll that one forward 6 months more or 12 months more into the future, and you will turn a losing trade into a winning trade. That's managing and rolling forward a position, according to David Jaffee, which I 100% agree with. So again, David Jaffee shows you that if you have a trading range and you want the range to be upwardly sloped, right? Whenever you are in the bottom side of it, these are good points to sell puts on the index, for example. Get comfortable with the trading range within, if you're selling 6 months forward, 6 months in the past, you look where the bottom half of that trading range is, and then just sell a put 6 months into the future. Like we're in the summer now, say it expires in January of 2022, 6 months into the future. So, also I wanted to show you this graph. This is a comparison of selling, 6-week options versus, a 6-month option. You might make 1% each time you sell premium, sell puts on the index. If it's going up, then you're always going to be okay. But then the risk with this is that your strike price starts to go up, and so if it goes down, you have all this loss to contend with. Whereas if you sell a 6-month put, then your strike price stays at this level. And so if it goes up and then it comes back down, it might not reach your original strike. And so you would have more opportunity to profit because of that upward bias in the prices of stocks. And so even though you make 4% versus perhaps 6% by rolling it forward every month or so, I still prefer to go longer because you have that security, that safety. So it's just food for thought. Overall, I tell you, I am a fan of David. He has come up with a wonderful way of communicating this strategy and articulating it for people. I've been selling puts for a long time, but I never looked at it quite the way David does. And he has my respect and admiration. I wish you the best, my friend. Be well.